If you blinked, you might have missed it. And yet we've been talking a lot about the very brief inversion of the 2-year and 10-year yield curve on Tuesday. There's been a lot of debate about whether it is indeed a harbinger of a recession. Most of the folks we've talked to have said it does not, at least not clearly. Here to discuss further is Evercore ISI Vice Chairman Krishna Guha. Krishna, I want to put a pin in the yield curve discussion for a moment because there is a number that came out this morning that caught my eye, and that is inflation-adjusted personal spending for February, which was down 0.4%. And it seems to me, leaving aside the yield curve argument, it is a problem if inflation is outspending what people are outpacing what people are spending and what people are earning for that matter. Is that something that you as an economist are worried about?
Oh, you're 100% correct that we need to keep a very close eye on real incomes. And we need to recognize that when gas prices, other prices rise sharply, of course it pushes up inflation today, but it also takes away purchasing power, weakens growth. And it's certainly possible that that might actually mean that inflation is lower, not higher, 1 or 2 years into the future. In fact, normally, if you started from conditions when inflation was, say, at 2%, labor market was in balance, the general rule would be that a central bank should look through the initial bump in inflation that comes when you get a big increase in the price of oil. For exactly that reason, because over the medium term, it's not going to add to inflation, and it might even subtract from inflation. The problem, of course, right now is the starting point. Right? Inflation was already too high for too long, and the labor market was already super tight by way of, say, looking at the unemployment to vacancies ratio. And so in this context, it's much harder for the central bank, the Fed in our case, other central banks elsewhere, to ignore what's happening at the pump and in terms of these near-term headline inflation prints.
Krishna, I'm an avid reader of your notes, and one of your latest notes, you mentioned that we could see the Fed lift interest rates by 50 basis points 2 or 3 times this year. What type of damage, if any, does that do to the U.S. economy?
Well, you're very generous. Thank you for your interest in the work. We see the Fed embracing the idea that they need more of a front-loaded sort of level step, if you like, back towards a more neutral interest rate setting that at least isn't stimulating the economy. Maybe it's not, actually slowing the economy down, but at least it's not pouring fuel on the fire. And our estimate, it's only an estimate, is that the Fed is going to pencil in something like 2.5% on Fed funds. Think of that as base camp. That's where they need to get to, and then they figure out how much further do they need to go to help bring inflation back under control. So when you do the math on that, if you want to be at, say, 2.5% at the end of this year, then you need to step up the pace with 2 or 3 50s across, let's say, May, June, and July, in order to try to get back towards that neutral setting faster. Now, does that in and of itself inflict a lot of damage on growth? Well, you'd be tempted to say probably not, right? Because in a literal sense, interest rates adjusted for inflation, the so-called real interest rates, which is what economists think really matter for the economy rather than the nominal interest rate. Real interest rates are incredibly negative right now. And even with a few 50s, they'll only be a bit less negative and still probably providing some support to the economy at a time when most people think we no longer need that support, and maybe even we need a little bit of restraint to cool things down in terms of the inflation front. So the initial answer would be to say that 2 or 3 50s ought to take some of the fuel out of the fire, but not put the fire out. Now, the caveat here is that sometimes rates of change can matter, particularly to market conditions, as well as levels. And, the market so far has been remarkably relaxed about, pricing in, starting to expect a few 50s. And so in a sense, the market seems to be signaling to the Fed it's going to be okay. But of course, we still don't know what happens exactly when you do it, partly because when you start doing some 50s, the market doesn't know when you stop. You do the first 50, well, guess you're going to do another, couple maybe. You do 2 or 3, could you do 4 or 5? And there is a risk that this can eventually get to a point where the market starts to say, hang on a minute, this is looking like something that actually could put a proper dent in growth, something where you want to go risk off.
At this point, though, Krishna, it sounds like you don't think that the Fed is tightening into a recession, for example. And I want to bring it back full circle to what I was talking about with the yield curve inversion. One of the charts in your most recent note looked at the term spread in the yield curve, but then you look at the, again, inflation, to come back to inflation-adjusted talk, you look at the real spread, in other words, the inflation-adjusted spread, which is quite a different picture. So what is that telling us about the footing the economy is on as the Fed is doing this tightening that you're talking about?
So thanks for referencing those studies. So, in thinking about the yield curve, what we say to our clients, and I'd say to your viewers, is the yield curve has a lot of information, but don't try and reduce it to one measure, like say the 210 spread. You want to look at yield curves plural. The short end, the medium term. You want to look at them in nominal terms. You want to look at them in real inflation-adjusted terms to get more of a holistic picture of what's going on. So when we do that, we flag up a couple of things that you mentioned. One is we do have to take into account, and forgive me for a little bit of technical jargon here, we do need to take into account what we think the normal term spread or term premium is between shorter dated and longer dated Treasury bonds. Now, in times past, go back a few decades, and in normal conditions, the 10-year would be trading 100, 200 basis points above the federal funds rate. When everything was fine, everything was normal. So if you go from that to a situation where the 10-year yield is less than the 2-year yield, something very extraordinary is happening, and that is flashing red alert for recession. But in the current era, since at least the financial crisis, arguably a bit before that, the term spread, the term premium, that is the normal gap between the 2-year and the 10-year, has come right down. Some estimates it's around 0, some estimates it's still negative. What that means is that when the economy is in balance, the yield curve may normally be about flat these days. And if it's about flat, then it is normal, and you go slightly inverted. It's not telling you anything like as strong of a signal as it did in the old days. The other thing, as you kindly pointed out, was we emphasized the need to look at the real yield curve, not just the nominal yield curve. So why? Right? One of the reasons, not the only one of the reasons why we look at yield curves for recession warnings is because the yield curve can tell us something about whether the market thinks rates will be higher or lower in the future than they are today or in the near term. Obviously, if they're going to be, market thinks they're going to be a lot lower, that is a sign that the economy is going to weaken. Recession risk is high. If future rates are expected to be higher than they are today, it's a sign that you're confident the economy is going to continue expanding. Well, you need to make an inflation adjustment because it's real interest rates that tell you how strong the economy is, not nominal interest rates. And so when you turn that 210 spread from nominal to an inflation adjusted or real calculation, in fact, that curve is still very steep. So that's telling us that we don't see particularly elevated recession risk this year in 22. 23 could be a very different story.
Krishna, I feel like I'm in an econ class in the very best way. Thank you so much for walking us through all of this and what we need to be watching right now.
I hope you do that in a good way and not in the falling asleep way.
Absolutely do. I absolutely do. Krishna Guha, Evercore ISI Vice Chairman. I feel smarter now. This is great. Thanks, Krishna. We'll talk to you soon.